Good morning. I'm just going to share with you an update on our land banking program in Houston. We definitely don't have a problem. And then I'll tell you a great way to spend almost $100 million. So let's get into it, and then we'll do charts of the week. As always, no direct investment advice or offers to buy or sell securities here. So I think by this point, most of us are aware of Gulf Inland Logistics Park. Fund One owns a chunk of this asset, which is approaching, well, excuse me, it's approaching a triple net of fees and carry. And so pretty impressed with this asset. The slide on the left is just the website. You can go check it out if you're, interested. And otherwise, the location of the asset relative to Trinity Bay in the greater Houston area is there, and you can see it. So that's great. The asset includes the 1,180 acres of the land, as well as CMC Railroad, and that is currently being expanded such that it connects with the main BNSF and UP lines that go into the Houston region more generally. And the good news is there's already 5 parcels that are in the sales process, completion to end users, and it's leasing up really, really nicely. And I think the idea here is that some of the manufacturing companies are just wanting to get ahead of, their planning, and have a good asset in a great location. And this is that. We're also in Connor's Fund 2, and this is an all cash land banking fund with a target of around 20%. And net unlevered to LPs of call it 15 to 17. They're probably a little bit ahead of that. And so the 4 properties that have been acquired, you can see there in the schematic on the right, it includes the land plans, the MUDs, drainage, and access improvements. Already sold about 120 acres in October and kicked out nearly $4 million to the limited partners. That was a sale of Mesa Vista and the MO Track 3, the second portion of Diamond Oaks. So they're really moving product down there. And really, in this case, the fund has one final asset, Bayou Bend, which is undergoing some entitlement work. And I think this will be, not to use the term easy layup too loosely, because these guys are just pros at this strategy. But it is, at this point, looking to a relatively comfortable 20% for our investors, which is great. River Ranch is the last sort of active one. We did enter 2 new deals with this group, but River Ranch is sort of, I guess you would say, midway through its vintage, and this is a preferred equity deal. The slides up top are the actual parcel of land, and you can see some work being done underway. And so, the project delivering about 750 finished lots last Q3 to 11 home builders, which is a bit, but that's great. Looks like we're on track for another 20 to call it 25% return on this one. So I know that there's quite a diversity of outcomes currently going on in commercial real estate, but in this case, it's all good news. And then this is sort of the cumulative distributions that we've had with some of the active LPs. Rosenberg is done. That one's closed. We made a very quick profit on that, and that was just really a fast moving. Like, I think that whole deal from start to finish was like 16 months. And I remember getting the email being like, really? So again, it goes to show you, if you buy land the right way and in the right location, you're probably going to make some money. Okay, speaking about location, so 13th Floor, which is one of our partners down in South Florida, bought this place for the arrows pointing to, just north of Curtis's house. This is about 15, 16 miles up from Venetian. And the idea here is Aventura is about 280, 290 unit complex right on the water, like literally right on the water. And they have a website. The website looks okay. It's more kind of got that nice, I guess, flavor to it, but it's nice. And I think the idea here is the 96 million bucks is just the price you got to pay to secure something like this. And also, I think 13th Floor has a fairly good reputation in Miami and ability to close on deals. It's not always let's try to get the absolute maximum price, because, if you're trying to close these things and it doesn't happen, you've chewed up a lot of time and a lot of money. This particular property, obviously generates a pretty predictable cash flow stream, and they're going in at just under a 5 cap. The long-term plan is really to redevelop this into what else? Condos. So you can even imagine, two twin towers there on this site, which is just under 9 acres. It looks small from the helicopter, but this is almost 9 acres of land, and there's going to be 2 luxury condos there, about 300 units in total. And for people that kind of have been investors in the fund, this is something they've done before with an LP called BP Group, which was Blue Palms in North Miami. It was, in my notes, I wrote it down as the 2 blue towers, because they're like really blue when you're coming up into the northern part of Miami. Like, they literally shimmer, which is cool. So anyway, so there's that. So that's just sort of an update on real estate. Obviously, not everything in that world is going great. Stuff's okay for us. Charts of the week, I think Andrew's sort of in the boat of things have settled down a little bit. Took a look at the VIX, which we'll see in a moment. It did come back down a little bit, as did the S&P 500. Well, excuse me, the S&P 500 as a function of the US 30 years also turned around nicely. So that's a good sort of point for people wanting to dip their toe back in. He's kind of in the table of, he's sort of on the side of the boardroom of, he'd rather see some improvements in stock prices, even if it means buying at a higher price, which to me is more, again, just like we talked about with 13th floor, it's more in the way of sort of confidence that what you're doing is sort of the right thing to be doing, as opposed to, reaching for every single last penny. But here you can see the S&P 500. We all know what happened here. And I think the one thing, you can say about these, squiggly lines is that usually when it goes all the way down to that lower or lowest third standard deviation line regarding the 50-day, it doesn't really spend too much time down there. So, really the idea there is just to consult with your investors and sort of explain to them that extreme volatility usually doesn't last that long, or hopefully not. The indices look just atrocious, with the exception of gold. They're really punching higher. Andrew does like gold. He does think it goes even higher still, and so that's a positive, I think, for our investors too. We really got to figure out what's going on with crude oil and see how that impacts individual holdings. As I said, the main sort of charts that stood out to me personally from this one is just sort of the VIX coming back down to, reasonably normal levels, but also that lower right-hand chart of the S&P priced in terms of the 30-year bond. That's something we've been kind of seeing a little bit more on our, investment type of emails. So we have more guys talking about stocks priced in terms of bonds, or stocks priced in terms of gold. So that's kind of interesting to just sort of take a step back and see that. The biggest mover from a sector perspective is going to be healthcare. And I kind of went back a couple of meetings just to go look at these sector rankings. And I think the one thing I'll say is there doesn't seem to be any sort of ability to connect the dots. Like, the movements of these sectors in any given week, to me, seem almost, totally random. Like, I have no idea why these various sector rankings change as they do week over week. And so that could be more just kind of the politics and the media spinning off something that, Trump or Kennedy's going to go after pharmaceuticals or whatever. But you are seeing these kind of erratic movements in the relative standing of the sectors relative to each other. The cup and handle, he's very positive on. I think there's another one for gold that's even more positive. But, the idea here is that he does think after he still again needs some more, I guess what you call corroborative evidence that the malaise from early April is over in terms of that. And even the Fed yesterday, I believe they were on hold. I can't remember that for sure, but it seems as though maybe those who thought Powell was going to cut rates were wrong, and I would be in that camp. So shame on me. These are the various support vacuums. I think at this point, it's probably clear that they have done the top end of these support lines have done their job. Perhaps the more important thing on a go forward basis as to whether you kind of quote dip your toe in or make a larger allocation of your portfolio is the upper band of overhead resistance. There's actually two, and we're sort of going through a patch of it right now. Andrew feels that at the very minimum, we do need to get to that upper, wider band of overhead resistance, kind of hang out there for a bit and show investors that they're really not afraid of being at higher levels. And that would eliminate, in Andrew's mind, the idea that sort of a secular top has been formed. He really likes gold, and I didn't check it this morning on Kitco or any of the sites, but he says his minimum price projection for gold is 30.50, which I think we kind of already smashed through that pretty easily. I'm just going back to gold here. It's 3,200. So this is maybe a little bit of an older projection that he's got. He'll have to kind of update that. And then lastly, Fed funds rate. I mean, it it did nothing when the tariff war was sort of front page news. It still is. But it actually popped up a little bit, which, I obviously have to study interest rates a little bit more, which is good, right? Education's great. And that's it for me.
Okay, thanks, Joe. Ken, are you good to go?
Okay, just go over the usual report here. April 17th, same disclaimer. The front end, just contact us today. Just quickly looking at the S&P 500, there's a $3 decrease week over week, 4 column changes, so kind of that whipsaw that we've been seeing, but a little less magnitude to the moves in the past couple weeks. It did not create a buy signal. You can see it stalled out here at this resistance, so something of note there, a couple lines of resistance. It's created on its way down. It's been making lower highs, so that is a concern. And the S&P did get close to its trend line here when it had that large drop, so we'll have to see if it remains above that trend line. The other two indices did not recently. On a overbought, oversold every week since February 21st. It's been oversold for the last month, so really no improvement in the technical data there. Looking at the NASDAQ, 11 box decrease week over week, numerous column changes, really led by a 4% plus drop yesterday after the Fed made their comments. It is approaching support from last week at 17,800. There's another support line that we reached back at the low earlier this month. But for now, it really does seem like the NASDAQ is the weakest on a technical basis. On the overbought, oversold heavily the last 7 weeks in a row at greater than 50%. That didn't happen in 2022. You'd have to go back to 2020, right at the start of COVID, where you saw a 7-week period like that. And then even before that, 2018 never had that. And that's as far back as I think the data went. I think my computer started stalling out when it was downloading earlier data, but nonetheless, kind of something of consequence there. I'm looking at the Dow. $4 decrease week over week. Still only two sell signals, but it has created 2 sell signals and then returned to a buy signal and bounced the last 2 times. It's kind of broken down, so we'll see if it can create a buy signal here. It's only 5 or 6 boxes above where this resistance is, so something to note there. Overbought, oversold the last 6 weeks, continuing to trend lower here. It is important to note value is outperforming growth, and it continues to. This chart looks like a dramatic drop, which it had from the end of January, we'll call it start of February. but I'm pretty sure the Dow is only down in the mid-single digits this year to date, relative to the NASDAQ, which has a bit of a nastier pull down. Looking at the TSX 60, quietly, the TSX gained some strength here off that bottom. Really some relative Canadian strength kind of being propped up by a stronger loonie I'll talk about in a couple of minutes, but nonetheless a buy signal, which is great. First one since January, so something to note there. It did increase its price target, so getting a little bullish there, up to 16.20, which is actually not even being shown on this chart. Overbought, oversold, increased week over week, but it's still being oversold for the 7th week in a row. We'll see if it can reach this heavy resistance area. You can see that it's created, and then the trend line here as well, only a few boxes higher. Looking at the VIX, did create a sell signal, still remains elevated despite the pullback we've seen, and it's pointing to a 2% target, which is the lowest I've seen in years. Now, I think that could just be that we had that spike and then we had a bit of a pullback. So I think it might just be a false data point, but nonetheless pointing lower, at least right now in the short term for the VIX. These technical indicators all reversed, no surprise, way oversold, I had mentioned, especially with that 12 and 10% day that all the indices had. I think at the end of last week or mid last week, these charts all reversed. Same with the percent positive trends, except for the Dow on the right. These are a little slower moving charts, so expect them to increase in the coming week, especially the Dow, which on a relative basis looks like it has a little strength compared to the indexes, or the more growth indexes, I'll say. Then the Toronto Stock Exchange here, despite the turnaround on the underlying index, you got some weakness here on the technicals, but these are slow moving charts, so nothing really of note there. Just looking here at the asset class rankings. After last week, obviously a lot of changes. This week, not so many. It is important to note developed currencies there at the bottom has gained a few buy signals, assuming that closes the gap on the US dollar in the coming weeks. And then at the bottom, international sovereign debt increasing, inflation protected debt despite the tariffs, lost 7 buy signals this week. Obviously there's some I think the website's called Trueflation, which is the current rate of inflation. It's hitting a multi-year low right now, but the tariffs obviously just went into effect. Could see that spike up in the coming months. Technology only has 115 buy signals within the sectors. Just at the start of this year, end of last year, I forget which one, it was sitting at 230 buy signals, I remember. So cut in half in the matter of 4 months. Not surprised there. More of those value names, those defensive names at this top end of the sector rankings, financials, utilities, consumer cyclical have gained buy signals in recent weeks, despite some strength in the materials area. Materials still lagging. It seems that there's a bit of hesitation from investors right now. We'll see what happens. And then kind of the first crack we've seen in growth is the mid-cap growth names lost 9 buy signals this week to flip positions with mid-cap blend funds. So something there in the style that could reflect some perhaps value or even blended fund outperformance relative to growth. I mentioned the dollar created its 3rd sell signal. It did that back in 2022 and in the start of 2023 after I think this is where the Fed, I think, stopped hiking interest rates, or by memory. I'm not exactly sure on the dates there, but nonetheless continuing to break down. But you can see it's broken down to a multi-year low, and it's sitting right below that $100 range, which, or we will call that the dollar range, but really seems to have broken through a critical point there, to a multi-year low, and this devaluation of the US dollar that Trump and some of his advisors had talked about is seemingly coming true right now. So we'll see if that continues. This is the Canadian dollar, US dollar cross rate. You can see the Canadian dollar breakout that we've seen recently. Off that bottom, I think in February it was 67 cents or something like that. Now we're sitting at about 72 cents. It's pulled back recently, but you can see it's about to break out of a multi-year negative trend. So perhaps we can get a breakout and it shoots up closer to 75 cents, which was the high in 2023, and a three. Right, sitting right now, that's a 3-year high there. This is just the daily return distribution going back to 1970 for the S&P 500, just to graphically describe those massive moves that we saw in the S&P 500. Basically, over the last week and a half, you can see the 3 big losing days that we had and where they're sitting here and how many standard deviations that is away from the mean. And then you can see on the right how large that gain was, sitting in the 99.9th percentile of daily return in terms of the distribution of the S&P. So some interesting times, obviously, when you zoom out. Looking at the price of gold, little pullback, but we saw it bounce yesterday. I think it was up 3% while markets were down 2 to 4%, anywhere in there. We think it's going to continue higher. There seems to be continued demand from global central banks, continued demand from investors. Gold's up about 23% year to date. I saw, if you've been holding gold, I think over a 15 or something year period, you're basically in line with the performance of gold, the S&P 500. I did not fact check that. I'll probably fact check that later today. Nonetheless, continued heavy demand globally, institutional investors, individual investors, central banks. There seems to be some worry with inflation, but also some volatility worry, which gold, there is some stability provided by the price of gold. Nonetheless, this is the mining ETF GDX. It's up 50% year to date. Might be a little overdone. It might have some horizontal price movement in the short term, at least, but nonetheless, it still trades at a PE of about 21. That's a weighted average PE, so still cheap relative to some sectors. A lot more expensive than if you were buying it last year. We own a number of miners in this space, which we're pretty happy with their returns. We're not looking to exit for the majority of them, but the shares outstanding, I will say, for GDX is at a 5-year low. So there's been a lot of redemptions recently in the GDX. Perhaps that's a lack of investor interest, or even some recent margin calls from large institutions where they're covering there. Mentioned the interest in gold in China. You can see here, this is the Shanghai trading volume for gold, and you can see just the explosion we've seen. Probably see this to continue, with, especially if the trade war between the US and China worsens. We're going to assume that China will start or continue, or whatever you want to say about that, dumping US treasuries, and they're going to rotate that somewhere else. We don't think there's another major replacement there other than gold for these central banks, so look for that to continue. This is just the ratio of US large caps to small caps. We're at a basically 25-year high now at the 99 peak. Obviously, small caps have really been hitting the teeth. I think I talked about how they performed really well from like during last summer, early fall, but now their relative performance compared to large caps over the last 5 to 6 months, since November-ish, it's been horrible. We could see this turn over, but we'll have to see. And then just highlighting this is just a company I was looking at that we own right now across a lot of accounts. Had this for a while. Nutrien obviously has had a pullback over the last few years, kind of swung up and down within this range for just about 2 years now. But it seems like the technical picture is improving. It's making higher lows. It's up 14% year to date. It's about to enter this resistance zone and trend positive for the first time in over a year. So something we're really watching with our interest in the company. And I think that's it for me. So I'll pass it over to David.
Yeah, that's great. Great update there, Ken. And yeah, make a note for Nutrien if it gets one more box that we should take a much closer look at it. Okay, because then it will have broken out. And I'll start with Michael Coolbaugh. Okay, so a bunch of things here. Consumer sentiment is now at similar levels to the depths of the COVID crisis. Only problem is it doesn't appear as though fiscal or monetary policy is coming to the rescue. He's very bearish. Political affiliations are still key in these sentiment surveys, but even Republicans are starting to sour on the outlook. Sentiment deteriorating, and not just the consumers. So even the CEOs are. CEO confidence is now plunged to the lowest since we were just out of the global financial crisis. Non-farm payrolls. At a certain point, tariff headlines won't matter. The chaotic uncertainty may introduce George Soros's theory of reflexivity, where collapsing sentiment can fuel its own reinforcing recession. There are a number of clear technical levels at play for SPX. I wouldn't be surprised to see us bounce around, testing many of these over the months to come. Per Renaissance Macro Research, last Wednesday was the 10th best single-day percentage return of the S&P 500 going back to 1926. For the historians, the other 9 dates don't bring a whole lot of comfort. Okay, for those who say the outperformance of rest of the world over US has gone too far, too fast, here's a look at the relative performance of the rest of the world versus the S&P 500 since the global financial crisis. It's been a one-way train for global capital flows. Yeah, so that goes back to 2010. As Joseph Wang points out, rising yields, weakening dollar, jump in repo volumes, tighter swap spreads, and surging gold suggest an exodus of foreign real money investors. Foreigners hold a lot of dollar assets. If they were to rebalance away, then prices have much more to fall. The DXY, worst start of the year on record. That's the US dollar spot index. Bank of America bull bear indicator. Looks like it's right in the middle. Despite all the angst, Bank of America's bull bear indicator is only neutral. A lot of investors are overly eager to call for a bottom. Okay, well, that's some interesting stuff there. And moving along to the morning coffee. It just came in, so there's some comments about United Health Group. It's down 18% this morning. Okay, so that must be a director buying TD stock. It's probably a good idea. It's been quiet for a while, so they must be regrouping. I'm not going to do the that today. I'll just go to the price performance. So Canada's still in the red for the year to date, except for our venture exchange. Looks like a lot of the rest of the markets are in the red. Step in Europe, Germany, Italy, UK, and India's come around nicely. Okay. Crude oil showing a little bit of greenery in the last week. Nat gas looks terrible. Gold has been pointed out several times. It's just incredibly strong. All green. Look at the year to date, the 1 year, nice 10-year return of over 10%. Silver's trying to catch up, and copper has been strong over the last week. I'll show the Canadian US dollar on the point and figure charts. Bitcoin's trying to catch a bid, and that's it for that. Let's look at the headlines. Change. That's a good one there. Okay, Trump, United Healthcare. Yeah, okay. Some interesting things there. Finishing up on point and figure, then I'll pass it over to Ross and Gilbert. Okay, the Canadian dollar is up to 72 cents now, so it's appreciated a bit in the last couple of weeks. The long-term indicator measures up to 79, and the short-term still measures down to 62, so getting mixed messages there. The US dollar spot index, Ken already showed down, it's broken 100, and yeah, so it's trending down lately. We'll see how long that lasts for. Okay. Crude oil still looks terrible, as does nat gas, as does the producers. So we'll be on a holding pattern with those, and maybe even a lightning pattern with certain names. Actually, Ross and Gilbert, maybe you can talk about that during your conversation, because I know you spend a great deal of time on the energy sector on your Tuesday podcast. Copper measures down, uranium down, gold measures up. Look at that, to 3,800 on the futures. That's as high as I've ever seen it. On the spot, It measures up a tiny bit. And the gold bug index, big up. The Van Eck majors, big up. The juniors measured down, surprisingly. I guess they've had their run. And then silver measures down. But the silver miners measure up quite a bit. And the junior silvers measure up as well. So the precious metal complex is the only thing happening really in commodities right now. And yeah, we'll see what happens there. Crypto, Ethereum looks up, as does the index. And then finishing up with interest rates here. Let's see if they've changed. And so 2-year looks the same, 5 years the same, the 10-year up, and the 30-year up. I've been updating the 30-year on a daily basis now for some time, and it's sort of bouncing around here at the high end, but the trend does continue to look to be up, and that over 6% handle in the future is quite ominous. Stay tuned for that. And that's the end of what I have to say. Ross and Gilbert, over to you. I see you've got a new platform. What made you change to this one, and are you liking it?
We've been, I don't want to bring up ancient history, but in June of 2022, we had effectively what was a double top. And I put out a small piece pointing that out. Now, the thing about that is that we really did come down with energy throughout this period, yet energy stocks held up relatively well. In fact, some of them went on to make new highs during this period. What we've seen recently in the wake of the tariff announcement is a breakdown of what was this sort of shelf of support around the $65 level, which obviously isn't good for the Eric Nuttall's of the world. But what this represents is a 50% decline in the price of crude oil, WTI, since the top. Now, I'm going to do what I always do, which is take a look at history, take a look at historical examples, and ask, how can we put this current move in context from a historical perspective? And that's exactly what we did in the next slide. When we go to the next slide and take a look at the long-term chart of crude oil, this is crude oil since the start of the 2000s, which is when it first broke above that $40 level. And I guess we were in a new market for energy subsequent to that, globalization, the rise of China, India, what have you, transportation. What we've seen is 3 periods of, I'm not even call them bear markets, because what these were declines of 50% or greater. Bear markets, we know, are 20%. When it comes to energy or even commodities, you get bigger swings. And so what we had are 3 periods where we've seen declines of 50% or greater. The first being in 2008, the second being in 2014, 15, 16, and the third being 2018 to 2020. Now, what's interesting is that we are currently in a period where we've seen crude oil decline more than 50%, right? So from the highs in June 2022 or February 2022 to today, we've declined more than 50%. So we can say that the current decline is in line with previous major declines. Now, what's characteristic about those major declines that could provide us with some guidance or some pause when it comes to where we see the energy market right now? Well, first of all 3 of these declines corresponded with with recessions in Canada. 2008 was a global recession, and so a decline in energy prices like that saw a global recession, which included Canada. 2014, 15, 16 was the advent of shale. And remember, when energy prices were up at around $100 a barrel, it was very easy to go up to Fort McMurray and start to take all that bitumen out of the ground, boil it up, and turn it into profitable energy prices. Well, with the advent of shale in the United States in the back end, what happened is that that was no longer the case, and we saw U.S. go from an energy importer to an energy exporter. And as a result, the price of energy declined, and those projects up in Fort McMurray and the rest of Alberta were no longer profitable. And as a result, you saw a price decline. We also saw a recession in Canada. 2019, 2020, that's obvious. That was COVID. We had an entire global shutdown. So what we have is historical precedent of 3 periods of time where we've seen energy prices retreat in a very pronounced way, and 3 effective recessions in Canada, but also 2 out of the 3 were representative of recessions on the global scale. Now, whether the slowdown in 2014, 15, 16, it wasn't a recession on a global scale, but there was a relative slowdown there. And so when we take a look at the current move in context, it's not unlike the previous major declines that we've seen. One thing that's also important about all those declines is that they didn't bottom until energy prices got down to $40 a barrel, right? We're still at 60 right now. And so $40 is a long way from here. Now, that being said, there are a lot of wells that will turn off well before we get down to 40, if we get down to 40. And as a result, we very well may see the price not decline in the way that we've seen in 2008 or 2020, obviously. If we go to the next slide, however, we can see the XEG, which is the Canadian Energy Stock ETF, again, corresponding with the moves in crude oil itself. 2008, we saw a big decline. Then from 2016 all the way down to 2020, we saw another big decline after run-ups. We've had a pretty big run-up since the COVID lows, right? This is a 10x, depending on where you measure it. And one thing to point out is that we are sort of breaking this trend line here. However, what I would also want to look at from just a statistical perspective, and I didn't do the data for this, but buying the XEG $14, $15 a share has really never been a good long-term strategy. If you go back and you ask yourself different periods where XEG was at $14, $15 a share, and you were holding for a year or 2 years, you were either flat or you ended up going down. And so the concern here is that on a relative basis, even without the broken trend line that we're looking at right now, energy prices may have some ways to go, or at least might not be attractive in terms of potential upside. The next slide is the XLE, which is just the US energy ETF, so energy stocks. It's the same sort of story that we're looking at here. Big trend lines, as soon as they get broken, we see declines and then sideways action. It's now at levels that it's never been at before, right? So very elevated in terms of pricing. And we saw that even though energy prices have declined from the highs in June 2022, the energy stocks themselves, which were relatively cheap, obviously, they managed to make push to new highs. However, the recent decline in energy has seen a break of this trend line. And so I'm not painting a rosy picture when it comes to this. And I'm obviously not going to get a job offer from Eric Nuttall anytime soon, because this is really not something that energy bulls are really looking at. However, I'm just looking at this from a historical perspective, and this is what the charts tell me. So that's it for me. Ross, if you want to go ahead and take over, feel free.
Chris Curry, do you want to jump in?
Yes, sure, Dave. I was on mute there. I have to jump in a couple of minutes as well, too. But the Bank of Canada, as we all know, paused at the last meeting. And I think the Bank of Canada and the Fed, obviously, given Powell's speech yesterday, they're wrestling with the two tensions of inflation and looming recession and unemployment. The thing to note, I think, is that inflation is 100% on the Fed's shoulders, whereas unemployment, the fiscal side, i.e. the government programs like, raising unemployment, stuff like that, they get help from the government on the unemployment side. So I think they're more inclined to favor fighting inflation, and that's clearly the pattern. But all the sentiment surveys that Ken has mentioned, grim. Powell dismisses these, which I don't think is a reflects well on him. He says surveys say X, but people go out and do Y. Well, I think that's really trivializing it, which I think is a mistake on his part. The Bank of Canada, typical Bank of Canada fashion, pulled their forecasts. They came out with two possible scenarios or talking points, not even forecasts, which, may be somewhat interesting. Our forecast is for 2 more cuts for the Bank of Canada, but I would point out Canadian interest rates are super low. They don't have much to go. Canadian 5 years at 2.7%. These are really low numbers. So I think the banks, really see, in case of a real severe recession, they need to have some, firepower to cut rates. So I think they're going to be holding off for a couple of meetings here. Last point is Quebec was downgraded to a single A. So there's a lot of Canadian companies that are higher rated than Quebec now, sort of something, point of interest there.
Interesting. Looking at the U.S. indices, the Standard & Poor's came right down to support levels. And actually had a pretty nice bounce there, about almost a 10% bounce there. It is heading back down to support level again, which occurs at about 100 roughly. So far, we don't have a sell signal from the Standard & Poor's. Could you go to the Nasdaq, please? Next slide. Same thing with the actually the Nasdaq actually came down through cut through support, had a nice rebound, and appears now its support level is 18,400, and this morning it's just below that level, so it's kind of hanging in there. So right now we can't say that we've got a sell signal from the U.S. market, and it is at support. And going to the next slide, which is Canada, pretty much the same thing right here, down to support, and has bounced off there as much, I think, on gold as indeed anything, and we remain fairly bullish there. Actually, we remain quite bullish there, because when we look south of the border at what's going on, the weakness of the U.S. balance sheet, I think, is very much in the process of catching up with it. If we look down the road for the balance of the year, if we have a weakening economy and tax cuts coming there, which the last three Republican tax cuts had a deleterious effect on the quality of the U.S. balance sheet. This time we are sitting right on a condition where we would anticipate, actually almost regardless of anything else, that we're going to have higher inflation due to weakness in the US dollar, which in turn is due to the weakness of the US balance sheet, which is weak and getting substantially weaker. So we remain quite bullish on the outlook for the outlook for gold. So we're positive there. Gilbert has talked about our oil outlook. Interesting, because when we look at everything, the balance sheets are really good. The fair market values upside are really good, and a number of the stocks are fairly on the cheapish side. But it very, very much depends, as Gilbert said, on the trend of the price of oil, and that we are less clear about. One thing I might point out, by the way, that Trump has reversed the U.S. Stand on the use of coal, which is interesting, because that certainly flies right in the face of everything that people are trying to do about global warming. But anyway, that's what he's done. I went looking for any U.S. coal stocks that might be interesting, and only found one actually that looks interesting at all, and that's a company called SunCoke Energy, which has a good balance sheet, is cheap both on its fair market value and its valuation in the market, trading at about book value. Anyway, David, that's about all that I wanted to say. I was, by the way, quite interested in one thing, and that is to say that Powell seems to be admitting that the ability of the Fed to stick handle its way around the inflationary effects due to the uncertainty caused by he has admitted that it's going to be very, very difficult for the Fed to counteract those. Now Trump, of course, was really incensed at that, thinking that the Fed can drop interest rates and get them out. But the last time that they did that, which was the COVID pandemic, and really goosed the issuance of debt in order to reverse the COVID effect. Well, we know what happened there. Yes, they managed to do that, but they certainly drove the inflation rate way up, and with it, interest rates way up. So I think Trump should be careful what he wants.
Okay, that's great. Thanks, Ross. Thanks, Gilbert.